Meanwhile, oil prices sliding Monday on a report that a ceasefire between Israel and Lebanon-based Hezbollah may have been reached. Joining us now is Stephen Schork, the Schork Group principal. So, Stephen, always great to see you. We did have those headlines, those reports. Stephen, possible ceasefire between Israel and Hezbollah, its impact on the oil market. Walk us through it. How do you see it?
Yeah, absolutely. It is, and let's hope we do see this, that it is a bearish driver for oil prices. We've seen a bearish environment overall in the market. It's a market that has perplexed me going back to October 2023 with the start of the war with Gaza. And all of that has meant to the disruption of flow of oil out of the Middle East and the extra cost. It has not had any sort of significant impact. We have had a couple of headlines that have pushed oil prices higher over the past 13, 14 months, but nothing has been sustained. So this is clearly a demand side issue with oil. And the issue has and will be, it has been for the last 3 years and will continue to be China. The growth of China, the expected growth of China continues to hit snags, and that continues to put a monkey wrench, as it were, into the bull's best laid plans for higher oil prices. So now we have the ceasefire in Lebanon, and let's hope this expands to a general ceasefire in the Middle East. And clearly, if we take that geopolitical headline out, then all we are now focused is on the demand side. And so we have the supply side fears. If we do ameliorate those, then all we have left is the demand side. And clearly, I think there's a greater risk in oil moving lower from this point than higher.
And it sounds like, Steve, it's Julie here. It sounds like that's because you think China is going to continue to struggle with the demand equation. So as long as that happens, oil could potentially be under pressure.
Absolutely. There's always, and has been and will be, continued potential growth in China. But at this point, it's been 3 years. We're waiting for it. We're waiting for Godot at this point. So I'll believe it when we see it. And what we want to really focus on, if you're looking at oil prices, look at the spread action. Look at the price on the forward curve of oil. For instance, if we look at the oil price, the average price in the first quarter of 2025 relative to where prices are in the second quarter of 2025, it is a premium. That is, Q1 prices are higher than Q2 prices. This is what's known as a backwardation. But what is really interesting is where this backwardation is trading. Compared to where we were prior to the start of the Gaza war in 2023, the Q25 premium is trading at 83 cents on the dollar to where it was trading 2 Octobers ago. If we go out and look at the premium of Q2 oil over Q3, Q2 is now only trading at around 69 cents on the dollar to where we are trading. So this spread action, when you see backwardations, premiums on the forward curve falling relative to the back end of the curve, this is your clearest telltale that the market is, one, either oversupplied or there's not enough demand. So clearly the market is telling us this is a demand issue and it is a bearish picture at this point.
So Stephen, with Brent just over 73 here, when you're talking to your clients, you tell them that's headed where, near to intermediate term? What do you see?
Well, we're trading ranges right now, and we go through our modeling, probabilistic quantitative modeling. Coming into this, the final quarter of the year, we had Brent prices at between 75, and actually, you know what? I want to be exact for your listeners here. So we came in here at Brent at around $72 a barrel. This was back in September. We finished last week at just over $75 a barrel. I'm coming up, I have a 50% probability that the market will hold, and this is what I'm telling clients and I'm telling you, will hold below $79 between now and the end of the year. And there's a 50-50 chance we'll finish right around $70. So at this point, we came into the quarter at $72. We're within a couple of dollars of that 70.25 is my median range there. So we're looking at a range of a 50% probability of the market holding in between $79 and $63. So my hedging clients, my producer clients, I like them hedging anywhere in the high 70s if Brent gets back above that range, because I do not expect to see significant momentum above that. Conversely, the end user, i.e. your refinery, if you can lock in oil at that $70 or high $60 range, this is an area where you really want to be taking advantage of.